When you're using a self-directed IRA, the most important rule you need to understand is something called the prohibited transaction rule. This is in section 4975 of the tax code. It sounds complicated, but it's really not. I'm going to break down what you need to know in today's video. Now, I'm Matt Sorensen, a tax lawyer. I'm the author of the Self-Directed IRA Handbook, the #1 book on self-directed IRAs. I'm also CEO of Directed IRA by Directed Trust Company, where we have over $3 billion in assets and 23,000 accounts of clients self-directing their IRAs to invest in real estate, LLCs, small business, private funds, crypto, precious metals. The world is your oyster with a self-directed IRA. But this prohibited transaction rule is one you've got to know. Now, I've lectured on this across the country. I've taught other lawyers. I've taught industry associations. I've taught CPAs, financial advisors. My job here today is to break it down into a digestible format for you to understand as an investor or someone new with a self-directed IRA. Now, the first thing I want you to know about a prohibited transaction is this is not about what your self-directed IRA can buy. A self-directed IRA can buy any asset allowed by law. All the things I mentioned just a second ago, real estate, crypto, small business, LLCs, private lending, private funds, your IRA can own those things. There's no restriction on those assets. There's only 3 things your IRA cannot own: life insurance, collectibles, and S corporation stock. That's it. That's the only thing in the tax code that is restricted for your IRA to own. So what is the prohibited transaction rule about then? It's not about what your IRA is buying as an investment. It's about who is your IRA transacting with. The IRS is super concerned about who your IRA is buying or selling assets to or entering onto other transactions. Why? Because your IRA is a tax-advantaged account. It doesn't pay taxes when it makes money or sells assets for gains. So they don't want you to manipulate it by transacting it with certain people that might collude with you. So that's really what the prohibited transaction rules are about, is restricting your account from transacting with certain people. Now, there are 3 types of prohibited transactions. The first is called a per se prohibited transaction. Now, a per se prohibited transaction occurs when an IRA transacts with a disqualified person. Well, the whole purpose of doing this is to have an IRA, and the only way I make money is if I transact it. So really what matters here is, am I doing deals or transactions with disqualified people? Now, the IRS has defined who is a disqualified person, and the first person on the list is you, the IRA owner. You are a disqualified person. Also, your spouse is a disqualified person. Your parents are a disqualified person. Your kids, your son-in-law, daughter-in-law, spouses of your children are also disqualified people. Now, not all family is disqualified here. Brothers and sisters are fine. Your aunts or uncles, okay? Your IRA could actually transact with them. Now, let's apply the per se prohibited transaction rule. Let's just have your IRA buy real estate here, the most common self-directed asset. If my IRA is buying real estate from my father, is that a per se prohibited transaction? Well, it's my IRA buying, that's a transaction, from my father, who is a disqualified person. So that would cause a per se prohibited transaction. Now, let's change the facts a little bit here. Let's say that my sister has an LLC that's a startup or a small business, and she wants to sell 20% of those shares in that company to my IRA for $50,000. Now, would that be a per se prohibited transaction? Well, let's look at the rule here. It's my IRA buying shares, which is a transaction, but who's the seller? My sister, not a disqualified person. So it all goes down to who is on the other end of the transaction. If it's some other third party or just some other business or investor people, that is not going to cause a prohibited transaction. But if it's you, your spouse, your kids, your parents, any of your spouses, for those of you in Utah, we will have a per se prohibited transaction. Now, a lot of people ask, well, Matt, what if I have an LLC? Is my LLC a disqualified person? Well, the tax code says an LLC or a corporation or other business entity is a disqualified person when 50% of it or more are owned by individuals who are disqualified persons. So let's go right back to that tree here of the family members, you, your spouse, your kids, your parents. If any of those people own 50% or more of an LLC, the LLC is a disqualified person. So let's run an example here. Let's say that me, my dad, and my sister own 1/3 of an LLC. Let's say that we bought a property, we fixed it up and rehabbed it. Now we're about to flip it. Now I decide I'd actually like to buy this as a rental property with with my IRA. Now, could my IRA do that? We have to look at what is the ownership of the LLC. In this example, more than 50% is owned by disqualified persons. So we have 66%, me and my dad. That makes the LLC a disqualified person or disqualified party, which would result in a prohibited transaction if my IRA bought the property. But let's change the facts again. Let's say I own a third, my brother owns a third, and my sister owns a third. And now we're trying to sell that property, and I say, hey, I want my IRA to buy it as a rental. Could my IRA buy it? Yes, it could. Now here I look at the facts, and the only disqualified person is myself. My brother and sister aren't disqualified to my IRA. I'm the only disqualified person, and I only own 1/3. I'm below the 50%, so the LLC itself is not a disqualified party. Now, the transaction needs to be fair. There can't be any manipulative value here, anything weird happening. Of course, my brother and sister aren't going to do that because they would get shafted in the deal, and they actually have control between the two of them, and that's the whole point of the 50% rule, and why Congress did that is they don't see any collusion here because you don't have full control of this. Anyone who is disqualified, those are the people the IRS doesn't trust in a deal. They can't force the transaction for some unfair value. All right, now let's talk about the second type of prohibited transaction. This is called a self-dealing prohibited transaction. Now, a self-dealing prohibited transaction occurs. Hey, I'm cutting in here because I want to make sure you know all the stuff I'm talking about on my YouTube channel, investing in alternative assets, whether it's real estate or private funds or private equity, oil and gas, crypto, saving on taxes, all these concepts I love and I talk about here. I want to let you know we do this at my company, Directed IRA. So get on over to directedira.com/call and book an appointment with one of our self-directed IRA specialists that'll help you understand how to take control of your retirement. Whenever a disqualified person benefits from an IRA's investment. Now remember the list of disqualified people. This is you, your spouse, your kids. Remember those people. If any of them benefit because your IRA makes a transaction or investment, that causes a self-dealing prohibited transaction. So, for example, let's say your IRA goes and buys a piece of real estate and you happen to be a real estate agent. So you say, hey, I'll take the 3% buyer's agent commission. Let's say the property was $200,000. So that results in a $6,000 commission to you as the buyer's agent and you receive that. Well, that is likely a self-dealing prohibited transaction because you personally benefited by getting that $6,000 commission from your IRA's investment. Now, I'm okay with you being the agent, frankly, on that deal and doing the paperwork and helping that transaction occur, but you would need to waive the commission, which could reduce the purchase price, and the IRA can benefit, but you can't benefit from the IRA investing. Another scenario would be, let's say you have a Airbnb or vacation rental property and no one's staying at it 1 week, and you decide, oh, I'm going to go stay there with my family because no one's going to use it. Well, now you're benefiting from the IRA's assets, and that causes self-dealing as well because you are a disqualified person. Now, the key here is any benefit, whether this is financial or use of the assets, any of those things will cause a self-dealing prohibited transaction. Now, there's another one that commonly comes up for real estate investors who are buying rehab type properties, whether these are being flipped or hold for rent, and that is you cannot perform services to a property that your IRA owns. So if I go buy a property and I'm going to rehab it, my IRA can own it and it can pay someone else to rehab it, a contractor, a handyman, whatever it may be, but it can't be paying me or any disqualified person to go put on the tool belt and go and do the work. That would be, frankly, a per se prohibited transaction anyways, because my IRA is paying me and I'm a disqualified person. So then people say, well, what if I don't get paid for it and I'm just going to do some sweat equity? Well, now this is a self-dealing prohibited transaction because you are benefiting your IRA. There's also an argument the IRS would typically make in this example because services fall under the definition of a transaction when we look at the per se prohibited transaction. So not to get too complicated here with how this works for the tax code, but bottom line is don't work on the properties and take payment, and don't work on the properties and not take payment. The IRA can pay people to work on the properties all day long. Just do not mix in disqualified people with any physical work or improvements on the property. Now, you can manage and oversee things as the IRA owner. That's totally fine. You can even go to the property and show it to people. You can do the lease. You can screen the tenants. That's totally fine. The IRS doesn't care about the administrative or management things. They want you to be involved with your IRA to help and grow and build it. They want you to keep good records of all of that stuff, but they don't want you to financially benefit, and they don't want you to unfairly provide value to the IRA by putting in sweat equity. Now, the third type of prohibited transaction is something called an extension of credit prohibited transaction. Now, this occurs whenever a disqualified person, this is you again as the IRA owner, you're number one on the disqualified list here, but this occurs whenever a disqualified person extends credit to an IRA. So for example, let's say my IRA is buying real estate again, and let's say that the property's $300,000 and I have $100,000 in my IRA, but I want to get a loan for the other $200,000 to purchase the property. Now, if I guarantee that debt and I use my personal credit to obtain that loan, that will cause an extension of credit prohibited transaction for my IRA. I cannot personally extend credit to benefit my IRA to make an acquisition or to refinance or get any debt on a property or asset. So stay away from guaranteeing debt or using your own credit to acquire an asset. Now, an IRA can get a loan to buy real estate. This needs to be something called a non-recourse loan. There's about 7 or 8 banks that we work with that lend to IRAs purchasing rental real estate. These are called non-recourse lenders, where they're going to lend on the property itself. Now, in the event of default, the only remedy that the lender has is to foreclose and take the property back. They can't go after you, the IRA owner, because you didn't extend your credit or guarantee it, and they can't go after the IRA either. So that's called a non-recourse loan. Typically have to have about 30 to 40% down on the property. It needs to satisfy certain debt service coverage ratios common in any real estate lending, whether it's a single family property, a duplex, or a larger commercial property. And then finally, this must be income producing real estate. Those are usually the requirements those lenders are looking for. But for purposes of the prohibited transaction rule, just do not guarantee the debt. Now, there is a famous case called Peek and Fleck versus Commissioner. This was 2 guys who had Roth IRAs. They went and bought an existing small business. And what they did is they invested their Roth IRAs into a newly formed company. That newly formed company went and purchased an existing small business. Now, the seller of that small business agreed to get a certain amount of money up front that the Roth IRAs paid for, and then he agreed to get a note for the balance. And under the note, the company, this new company that these Roth IRAs own, these 2 self-directed Roth IRAs, under the terms of that note, they agreed to pay back that seller over time for the balance of the purchase price of the small business. Now, there was a problem with the note. The IRA owners pledged personal assets and personally guaranteed that note. These 2 people's name are Peek and Fleck, where the IRS said this was a prohibited transaction, disallowed it. These Roth IRAs no longer were Roth IRAs, and we had a prohibited transaction. The sad part of this story is they sold that business for over $1 million profit to the Roth IRAs that would have been totally tax-free had they complied with the rules. But because they had this extension of credit prohibited transaction, their Roth IRAs were disallowed, and this was now taxable income on their 1040, which they had to pay taxes on. So the important point here is, again, do not extend your credit or give personal guarantees whenever your IRA is obtaining a loan to purchase an asset. Whether there's a bank lender involved or a private lender and there's seller financing on an asset, do not guarantee the debt. This will cause the extension of credit prohibited transaction. You will no longer have an IRA if you're audited. Now, the consequences of a prohibited transaction are you have distribution of your account as of January 1 in the year you engaged in the prohibited transaction, and you are subject to any early withdrawal penalties, plus an accuracy-related penalty if this was in prior years and not reported. Bottom line here is we do not want to jeopardize the tax advantage status of our self-directed IRA by engaging in a prohibited transaction. If we do, we lose it. We no longer have that tax advantage status, and we also subject ourselves to earning early withdrawal penalties if we're not yet 59.5, and other penalties even if we are under 59.5. So we want to avoid engaging in a prohibited transaction. Now, the downside of this rule is even if I have a small prohibited transaction in a large account, the whole account gets distributed. If I have $1 million self-directed IRA and I engage in a $10,000 prohibited transaction, the whole $1 million IRA is distributed. So we want to avoid these. We want to be careful. Make sure you're not engaging in transactions with yourself or benefiting yourself or other disqualified persons. Now, most of you self-directing your IRA weren't even thinking of doing that, but just in case you were, I want to make sure you understood the prohibited transaction rules. Some of you get creative. You invest personal dollars and IRA dollars, maybe your IRA, your spouse's IRA into deals and transactions, and knowing these prohibited transactions are critical to make sure you don't have a mistake that ends up disqualifying your IRA. Now, the general statute of limitations for prohibited transactions and getting audited for that is 3 years. However, they can go back an additional 3 years for a total of 6 if the IRS gets approval from the Assistant Secretary of the Treasurer and the prohibited transaction would result in your adjusted gross income going up more than 25% or more. Now, I have never seen that additional 3-year rule apply. I don't even know who the Assistant Secretary of the Treasury is that would approve this. I've never seen this come up in 20 years specializing in this field. So what I would think about about really here is the 3-year prohibited transaction statute of limitations. Now, the statute of limitation actually never expires if it is determined you have committed fraud, so do not try to manipulate these rules or commit tax fraud and thinking that, oh, if I just wait 3 years, things have passed. We want to make sure we're doing things right, we're complying with the prohibited transaction rules before we engage in transactions. And again, if you're just making regular transactions and investments with other third parties, don't stress about this rule. But if you're someone who likes to get creative, do deals with family, or get involved personally, make sure you understand these rules and stay clear of them so that you don't engage in a prohibited transaction. If you want to dive into this even further, download our guide below. And if you've got questions, you want to get your account going, our team at Directed IRA is here to help. Book a call, and our team will be available to help you take control of your retirement.